Hi, and welcome to the ECIO market commentary for the month of November. November was a good month for U.S. stock investors as U.S. stocks gained 0.3% to 3.4% for dividend stocks. Overseas investors were mixed. Developed markets were up 0.6%, while emerging markets lost 2.4%, and fixed income results were up about 0.7% for the month. That takes year-to-date results for the 10-month period solidly into positive territory, with U.S. stocks returning 4 to nearly 18%, overseas stocks returning 27 to nearly 30%, and fixed income results up about 7 to 7.5%. It has been a volatile period for the S&P 500 index over the past 12 months. It has returned 15.7%, but there has been a fair amount of volatility, including a nearly 20% downdraft, which started in mid-February, culminated in early April. And then you can see since that time, the market, the S&P 500, has gone back to record highs, up about 37% from those low points in April. Looking at sectors for the month of November, value-oriented sectors performed the best, while the technology sector was the big laggard. That was a reversal from what we saw the past several quarters and the past month. So we did see the S&P 500 sell off in the first half of the month and then rebound a bit. That sell-off was driven by technology stocks. A lot of investors are starting to get concerned about valuations and an IA, or artificial intelligence potential-driven bubble. Whereas value-oriented equities did outpace the broader market as investors rotated to those companies that had more compelling valuations. Bond returns were also positive. That was driven by a decline in longer-dated interest rates as well as the coupon payments. Investors did grow more confident that the Fed would likely cut interest rates in December, and incoming data reinforced this move, pointing to softer economic momentum and continued cooling in inflation. So the Fed indeed is scheduled to meet in December. The markets are now assigning an 85 to 90% probability that the Fed will cut another 25 basis points. So that would be the third cut. As you're well aware, the government shutdown did end on November 12th. It was closed for a record 43 days. That has delayed a number of the economic data numbers that we typically look at. The numbers that are coming out are pointing to a weaker employment market, which has reduced fears of an overheating economy. Consumer and business confidence also slipped in November. That was weighed down by that shutdown, as well as inflation, tariffs, and political uncertainty. Looking at households, lower and middle income households appear to be under some financial strain right now, while higher income spending remains relatively robust. So as we look forward into the last month of the year, we believe investors will be watching the employment market closely, consumer spending, the action from the Fed, as well as inflation numbers and economic growth signals, and of course, ongoing geopolitical tensions and trade uncertainty will likely continue to fuel volatility in the markets. So that concludes our update for the month of November. If your investment committee would like to meet with us, please reach out. Happy to do that at any time. And if not, we will see you following the end of the year. Thanks for your time and interest, and have a great day.